And good morning. Special thanks to all of our shareholders, and in particular to those who have made the journey down here today. We do appreciate that. I'd like to start by describing this year as a roller coaster. It went quickly. We moved the company forward with a lot of achievements, and we weathered a few setbacks and challenges along the way. All of this occurred within a very volatile landscape where high energy prices have become a political issue. Climate change policies are creating investment uncertainty, and growing regulation is slowing the delivery of gas into a market that is desperate for new gas supply. We are also here today with our share price in the single digits, and I'm sure you're all aware of that. I share your concerns that this valuation does not fully reflect the portfolio or the potential of the company. As Mick mentioned, this is something we're focused on addressing with the current strategic review, a key part of this effort. If we move now to looking at the year in review, the past year, I am proud of what we've been able to achieve and what we've been able to accomplish. One of the major achievements was the farm out of our subsalt permits to fund 2 new exploration wells next year. This transaction diversifies our exploration activities into helium and expands our subsalt exploration activity from 1 well at Dukas into 3 wells. Our underlying gross field production was steady, driving a solid financial performance. We booked a profit of $37 million on the sale of 50% of our producing assets, which crystallized a return on equity after debt service of over 33% per annum, which isn't too bad. We also reduced and extended our debt, which in previous years has been an issue and something that we've been working to pare down. We've been able to do that. And the extension has been a critical outcome for us, particularly given the shrinking number of domestic debt providers. And finally, we successfully capitalized on a strong rally in the spot prices over the past year by securing as available pipeline transportation just in time for the winter peak. But the year wasn't without significant setbacks and challenges. We continued to see cost pressures across the business, both in operations and in particular during our exploration drilling program. We faced difficult drilling conditions at Palm Valley 12 well location, impacting both our schedule and our budgets. We made the decision to drop 2 deep exploration targets, which was obviously disappointing, but at Palm Valley and Dingo, and reallocate those capitals towards producing investments. We were also not successful with our Palm Valley P3 appraisal lateral. However, the fallback P1 lateral did produce gas flows that were indicative of a good exploration well, so we believe that well has been salvaged and will turn out to be a real positive investment for us. At Range, and I'm sure many of you are interested in to understand where that project is currently at, our path to a final investment decision has been slow, as technical results indicate that permeability is complex and highly variable across the permit. We also had some HS&E incidents during the Palm Valley 12 drilling program. These are relatively minor, but they do highlight just how important safe and responsible operations are to our business in delivering gas and oil to our customers. And finally, aggressive climate change policies are creating noticeable headwinds for the oil and gas sector, both in terms of project delivery, operations, and in particular, and in growing issue, is the confidence in the domestic gas market. I'll cover all these topics more in the presentation, but I thought this was a good starting point and a bit of a highlight for what is to come as we progress forward. Let's start with the operations. Gross production for Mereenie, Palm Valley, and Dingo was consistent with last year. We booked $42 million in revenue in fiscal year 22, with a realized gas price that was 15% higher than the previous year, reflecting some of these strong markets that we saw over the course of the middle of the year. The sale of half our operating assets generated $36 million in profit on assets that were only acquired 6 years earlier. Again, this equates to a return on equity after debt service of over 33%. Our ongoing performance out at our fields reflects our operating team who have been dedicated to the safe and responsible supply of gas to our customers, both throughout the pandemic, but also importantly throughout our recent drilling program, which is not an easy task. Rising gas prices have also been in the spotlight recently. These higher prices are just starting to flow through to our financials and help offset the various operating challenges that we feel throughout the industry, including resource constraints, supply chain disruptions, cost inflation, and expanding regulations that ultimately delay the supply of new gas to market. Moving on to our capital strategy. In terms of capital strategy, we reduced our loan balance to $31 million following the partial asset sale, with net debt at a manageable $15 million at the end of September. We also extended our debt facility for 3 years to 2025. This was a critical achievement as debt funding for oil and gas projects is becoming increasingly difficult capital to source, with domestic banks simply refusing to take on new oil and gas projects regardless of credit quality. This is something we haven't seen in the past and is something that we think is going to be an emerging issue as we move forward. At the end of September, we had $11 million of the free carry balance remaining from our asset sale that is available to invest in certain future exploration and development. This money is expected to fund the balance of the Palm Valley 12 well that we're just wrapping up, as well as other development projects like our recompletions, proposed development wells, and the flare gas recovery project at Marini, which I'll talk more to later. As we move to gas markets, and certainly this is a topic that has gotten a lot of press recently, the chart that you see here shows a year-to-date spot gas prices in Sydney and Brisbane over the course of the year. Conflict in Europe combined with outages in coal-fired generation over the winter caused a significant mid-year rally in domestic spot gas prices. The extraordinary prices, however, have proven to be temporary, falling sharply in August, as you can see in this chart. The conflict in Europe, however, is continuing to put upward pressure on the spot market, which is still trending at around $20 per gigajoule. It's interesting to note that is about $10 or double what they were in the first half of the year. That is a substantial increase in the gas market pricing, particularly when you consider most of our term contracts and our financials are based on those lower numbers prior to the run-up in the spot price. I'd like to also note that most of our sales are under fixed price term contracts. This means that they will be rolling off over the next 3 years, and it is at this time that we will have the opportunity to recontract at higher prices. The full impact of these higher prices will therefore only become visible as we move and recontract over those future years. Having said that, we started to see the impact of high spot gas prices in our last quarterly result, where the average portfolio price for oil and gas increased by 20% compared to the prior year at $8.12 per gigajoule equivalent. So a substantial increase just in this last quarter, and that is the start of what we're seeing when these higher gas prices flow through to our financials. This increase in the last quarter was made possible by commercial arrangements we put in place earlier in this year to sell non-firm production into the East Coast spot market. And this was just in time to capitalize on the extraordinary mid-year price rally that you do see in this chart. And I would like to thank our commercial team for that hard work. That was a very difficult thing to put in place. We've been trying for a number of years. They successfully did it, and the timing couldn't have been better. Over about 4 months, Central sold 170 TJs of spot gas at that time, generating $3.4 million in revenue from it at an average price of over $30 per gigajoule. So it's a substantial activity, a substantial opportunity for us to increase our gas price and our revenues as we move forward. It's probably also worth mentioning the Northern Gas Pipeline. Obviously, that has been shut in since September and is temporarily stopping our ability to sell gas into the East Coast market, and in particular into the East Coast spot market, which, as you've seen, is still at very elevated prices. We understand that the NGP could return to service within the next few months. In the interim, obviously, we're going to be working very hard to place all of our excess production into the Northern Territory, who customers are both on a term and spot basis desperately require gas as that supply from Blacktip offshore has been declining. Okay, now on to a very topical subject, climate change and regulatory risk. Central take climate change and the associated impacts of climate change very seriously. This is why we are proactively progressing projects like our flare gas recovery project that will reduce carbon emissions at Merini by 25% when commissioned next year. In addition, our focus on producing gas as a low carbon transition fuel combined with very low associated CO2 and the relatively small environmental footprint of conventional gas from the Amadeus Basin gives Central some distinct advantages in navigating climate change policies that are targeting the oil and gas industry going forward. Having said that, the push to adopt renewable energy at an unsustainable rate and efforts to exclude gas as a transition fuel is very concerning. Over the past 5 years, there has been a growing campaign to demonize the gas sector, both from certain parts of government, from climate activists, and vested interests. All of this is designed to force the unrealistic transition to renewable energy in a time frame that we don't believe is in the best interest of Australia. This movement has now leveraged the widespread concerns about high energy prices, which are largely caused by that European conflict, in order to make domestic gas markets overtly political, with extreme policies like mandatory price caps now under consideration. And that's something I never thought I'd be up here talking about. It's a very big jump for a country like Australia with a market system to be talking about that. And obviously there's a lot of issues around that particular policy being floated. The many obvious issues associated with direct market intervention, one of them is that regulation introduced to mitigate short-term price shocks tends to become permanent legislation. And this has a massive impact on unintended consequences throughout the market over the medium and long term. And what I can say is that regulations like that will ultimately serve to reduce the supply of gas into the market at a time when a functioning domestic gas market desperately needs more gas supply. We'll continue to proactively manage the business through this fluid regulatory landscape, and I highlight that the global gas market fundamentals remain strong, with affordable and reliable energy a necessity for millions of residents and businesses across Australia. Moving on to our drilling program, which we've just completed with our Palm Valley 12 well. I'll be honest, not reaching the deep exploration targets at Palm Valley and Dingo was very disappointing. It is something that myself, the management team, the exploration group were very interested to get to and to test. We think there's a lot of potential in those deep targets. But it was also a necessary change given the extreme subsurface conditions that we had at that Palm Valley 12 crustal location and considering our obviously constrained capital resources. Our decision to pivot toward production was not initially successful in the P3 formation, but we had successful gas flows from the shallower P1 formation, which were generally in line with pre-drill targets. Having PV12 production well as a fallback to our exploration program proved to be a successful risk mitigation strategy that will now increase production into a very strong East Coast gas market in the short term. Moving to Range. Over the past year, we delivered 2 step-out pilot wells at Range, which were put on an extended dewatering test. We also arranged a data swap with surrounding permits. The data acquired through this swap, along with our ongoing pilot test results, are now being integrated into a detailed regional subsurface model, which will improve our technical understanding of the Range permit. Whilst we have not yet completed this modeling work, the preliminary indications are that permeability, which is a key driver in the production profile and the water production profile in the permit, across the permit is much more variable than what our exploration results had initially suggested. A more predictable and uniform distribution of permeability across the permit would have allowed for a single-phased appraisal program and an early final investment decision. And this is what we were hoping for when we started out on the appraisal program. Unfortunately, when we sit here today and looking at all the technical information we have, it appears that the permit at Range is a much more complex field, and that accelerating a financial investment decision is more difficult based on what we know right now. On the plus side, strong gas prices do provide a very big boost to the economics for the Range project, and we are working very closely with our joint venture partner, Incitec Pivot, to ensure that we move this project forward towards development as quickly as possible. We'll be keeping shareholders in the market updated as that joint venture decision is made, and we understand and we have some clarity about how we're going to progress Range going forward. Okay. Moving on to something that we think is one of the most significant achievements of the past year, and this is our farm out to peak helium. This farm out will expand our subsalt exploration from one well at Dukas, and when we were sitting here last year, we were talking about having a one-well Dukas program and quite excited about that potential. This farm out increases that to 3 wells, and it also includes a real focus on helium. So we now have included Mount Kitty and Mahler along with Dukas. That program is going to be kicking off next year, and it's incredibly exciting. It's a multi-TCF program targeting gas, helium, and potentially hydrogen. It diversifies our exploration, and it provides more opportunities for a company-changing discovery in the near term. The program is in full swing, with drilling to commence next year. At this point, the joint venture is progressing approvals, well design, and evaluating drilling rigs. Completion of the farm out, as you know, has been extended a number of times in order to facilitate regulatory matters such as stamp duty assessment. We don't see any critical issues at this time in completing the remaining CPs, and recent progress suggests that the transaction should reach completion in the short term. In addition to our 3-well subsalt drilling program that I've just talked about, we are also pursuing a farm out opportunities for the Zivon prospect, where we hold 100% interest. Zivon has the potential to be a very large subsalt target based on our play-based mapping, so we're hoping to progress seismic with an aligned partner as soon as possible, with the goal of identifying a drillable location and moving that prospect into something where we can drill in the near term. Moving on to our map of activities. There we go. You would have seen this map. It's been updated. In summary, we're connecting the Palm Valley 12 well that we've just drilled into our production facilities as quickly as possible to increase sales. As I talked about before, selling into the very high price spot market has a material impact on our financials. That's something we want to take advantage of. So we are accelerating those activities and trying to get it on production as quickly as we can. Palm Valley 12, combined with our plans for up to 6 recompletions and 2 development wells at the Marini field next year, we are well positioned to deliver increased production into what we believe will be a domestic gas market that continues to be short on reliable term gas supply for the foreseeable future. At Range, we'll be completing our subsurface modeling and working with our joint venture partners to determine the next steps to move the project toward development. And that's obviously something that is a goal of ours. We do want to progress Range, but we need to do it in conjunction with our joint venture partner, and we need to fully assess the technical information that we've just got, which, as I mentioned, indicates a much more complex field than we originally had thought. Our subsalt exploration program is also quickly approaching, so activity with these joint ventures is ramping up, with rig selection a critical decision that will be driving our drilling schedules. So as we get through assessing and evaluating and selecting drilling rigs, that will then flow into drilling schedules and timing for each of the 3 wells. We'll obviously communicate that to the market as soon as we get some clarity on it, but we do anticipate that drilling will commence next year. And finally, we are looking actively at farming out the Zivon permit to progress seismic and ultimately find a drilling location for that prospect. as well as Mamlambo, which we think is a very attractive permit. It's a low entry cost in terms of drilling. It's shallow, and it could open up a very significant oil province in the western part of our permit. So that's something we are also trying to progress at this time with some intent. Okay, I think we'll move to the year ahead, and I use this slide as really a wrap-up. I'd like to take this opportunity to thank all of our employees, our joint venture partners, traditional owners, and the communities in which we operate, along with all of our stakeholders for their continued effort and support. On many accomplishments over the past year now position Central to benefit from strong gas markets and major near-term subsalt exploration. At the same time, I recognize that we didn't achieve some of our objectives last year, including the testing of the PV Deep and the Dingo Deep exploration targets. Our appraisal at Range is also taking much longer than anticipated. And our sector is facing significant uncertainty as natural gas is considered by some to be a threat rather than an ally in the transition to a lower carbon future. Importantly, I share your concerns that the share price does not fully reflect the potential we see in our company, and management is fully committed to doing what needs to be done to address that. Operationally, this includes continuing to safely deliver reliable gas supplies to our customers. Technically, this includes delivering successful results from our upcoming exploration and appraisal programs. Corporately, this means keeping escalating costs under control, managing our capital, and delivering new growth opportunities through farm-outs. In wrapping up, I'd like to thank you, our shareholders, in advance for supporting Central over the next year as we focus on delivering these very important and clear objectives. Thank you very much.